So Tom Lee just dropped a new interview saying what he thinks the stock market's going to do in the next 8 weeks and how it's going to finish out the year. There's a lot of volatility in the markets right now, so I'm going to play the interview right now. We're going to see what Tom says. After the interview, we're going to go into one of my plays that I have a lot of money in, and we're up a lot on it too right now. I don't think it's too late to get in this play, but we're going to break it all down after this interview, so here we go.
Well, it's been a rough week. I mean, this September first 4 days were down 4%. It's actually one of the 5th worst September since 1928, so it's pretty bad. I don't think there's actually a lot of fundamental arguments for why stocks are down this much, but I think we've pulled forward seasonality. This September to November period last year was really tough. Historically, it's tough, and I wonder if markets are going risk off early.
So you believe in the soft landing story. You said there's no fundamental reason for this. This is a debate over soft landing versus something worse. Market seems to be tilting towards something worse. You say no.
Yeah, the reason I don't think it's something worse, and we don't know, is that the jobs added was better than July. Remember, July was the hard landing fears because it was such a weak number, and in fact, the number of industries adding jobs jumped to 53%. That's the best in 6 months, and the unemployment rate fell. So I think we're at a point where the Fed could engineer a soft landing, and that's why 2 weeks from now it's going to be important.
50, 25, does it matter to you?
I think it's going to be how the market interprets either number, because there can be such thing as a dovish 50 or a hawkish 50 or a panicked 50, even a hawkish 25. So I think the reality is the Fed is on a cutting cycle. That's really a good catalyst for rotation. Interest rates are going to fall, and it's going to help industries like housing, autos, credit cards come out of this recession. So I think it's good news when they start cutting.
Okay. What's happening in tech? We said that the NASDAQ's down more than 5% this week. We're having the worst week in about 18 months, and the tech sector itself is off more than 7 on the week. What's going on with that trade?
Tech, I think, revealed its hand last week because NVIDIA had a good number, but it fell. So when stocks fall on good news, it's either a crowded trade or something bad could be coming. And then, of course, they led the downside this week. I think it is part of this pull forward the seasonality because people want to de-risk, and tech is a big holding. In NVIDIA's last 10 years of history, there have been 30% drawdowns, almost 8 times of similar magnitude. Its PE, NVIDIA's forward PE, was actually higher at the bottom of those drawdowns. Right now, NVIDIA's forward PE is in the mid-20s. So to me, this looks like a normal profit taking. Maybe it takes NVIDIA down to the 90s, but I think 2 years from now, that's really going to be a gift. The risk of a 7 to 10% drawdown between now and November, we're almost down 5% now. I think next week we could be within that point of where we pulled forward that entire correction into the month of September. So I think we're close to the point where, I wouldn't be a seller here, and I think the lower range of the S&P's 5,400.
So Tom Lee just said that the next 8 weeks in the market are going to be very bumpy. There's been a lot of volatility happening right now. The markets have been up and down, going crazy. The mainstream media has been pumping crazy narratives every day. Seems like every day the market goes up, they say something bullish. Every day the market goes down, they say something bearish. And it's just a big media machine of keeping you in the cycle of watching media, but not really understanding what is actually happening in the market. So we're in the beginning of a Federal Reserve interest rate cutting cycle. So right now, interest rates are around 5.3%, and we're expecting to cut rates quite a bit. Heading into the CME Fed Watch Tool, we expect rates to fall from 5.5% to 5.25% at the next meeting on September 18th. So this right here is saying there's a 67% chance of cutting rates to 5.25%, and there's a 33% chance of cutting rates to 5%. Now, if we go 1 year out to September of next year, it's showing that the median interest rate is going to be somewhere around 2.75 to 3%. So that's a pretty big cut because right now we're at 5.5%. So we're looking at 250 basis points of cuts. But the problem is the market doesn't know how to price this in right now because there's so much data that's still got to come out. We don't know if we're going to go into a recession. If we go into a recession, they're going to cut rates more. If the economy stays strong, they're not going to cut rates as much because it doesn't need it. There's a lot of inflation data that's going to come out between the next couple of meetings. If the inflation data comes in soft, that's okay because that gives the Fed permission to cut. But when inflation is soft, that's kind of a function of if the economy is weak or not. So companies like Walmart, for example, if the economy is weak and there's not a lot of demand, Walmart is going to cut prices. So when they cut prices, that's going to bring inflation down. So that's something to keep note of. It's not just so simple as saying, oh, we want inflation to fall to zero, they could cut rates and the market's going to go straight up. It's not that simple, because if that happens, we're probably in a recession in the economy. Now, if inflation comes in hot, it's a double-edged sword. So what that means is there is demand in the economy. There's a lot of people that want to buy stuff, because remember, the pricing for everything moves in a function of supply and demand. So if there's a lot of demand, but not a lot of supply, prices will go up. If prices go up, the Fed's going to keep interest rates higher for longer. So that's going to hurt interest rate sensitive stuff, such as the Russell, such as car companies, and home builders. So it's a very dynamic situation, and Tomley said he doesn't really know if the meeting is going to have a 25 basis point cut or a 50 basis point cut, but he said it matters how they deliver the message. So if they do a 50 basis point cut in a way that is super bearish, that means that we're slipping into a recession and they're cutting rates because they feel like they have to. But if they do 50 because they just feel like we're just straight up too high, then that's okay, that's acceptable. And there's a lot of people out there that say, usually the first few months after the Federal Reserve does the first cut, we slip into recession and the stock market goes down. But that's actually incorrect. It matters how the economy is doing. If we have a strong economy going into the interest rate cut, meaning we're just cutting because we're just straight up too high, then the stock market usually trends up. But if we're cutting because we're going into a recession, we're cutting because we have to and we're trying to spur the economy, but cutting 50 basis points from 5.5 to 5, that's really not going to be enough to spur the economy back. So I'm going to show you a play that I just made. I've been talking about this play for a while, but I want to give you guys a quick update on it because it's absolutely printing money right now. So what I've been talking about in my other videos is TMF. So TMF, when I got into it, was roughly like 56 bucks a share, and right now we're around 63 bucks. So I am going to hold this play for a while, and I think that there's a lot of juice left in the play, and I'm going to explain to you right now how to know when to exit this play, because that's one of the biggest things with trading is when do you get in and when do you get out, and I'm going to show you exactly when I plan to exit this play. So TMF tracks the prices of bonds. So if you're in the camp that inflation is going to go down, if you're in the camp that interest rates are going to go down, TMF will go up because TMF goes inverse of what interest rates do. Because if interest rates go down, bond prices go up. And TMF is a triple leverage tracker on the price of bonds. So we need to look at this chart at a specific date. So if we go to March 15th of 2019, that is when the Federal Reserve first indicated in the last rate cutting cycle that they were going to cut rates. So TMF went from $194 a share all the way up to roughly 472 bucks a little bit over a year later. So that was roughly a 2.5x. So TMF right now is 63 bucks. So to keep numbers simple, let's just say TMF is going to double. So we're going to be over $120 per share. So I think there's a lot of potential upside in this trade. Nothing is guaranteed. Nothing always has to play out how you think it's going to play out. But I think the risk reward on this TMF play is definitely there. And then you're going to say, well, how much did they cut in this period right here? They cut roughly 2.5%. And if we go to our CME Fed Watch tool, we're expected to be cut roughly 2.5% from right now. So it's a similar interest rate cut, so I'm expecting a similar move in TMF. So this is the CME Fed Watch tool. Currently we're at 5.5%, as I've said before. And up here, we're on the December 18th meeting. So December 18th meeting, we're going to be somewhere in this range for interest rates. So let's just say we're going to be at 4.25%. So we're expecting to be 1.25% lower on interest rates in December versus right now. That's quite a big cut. Now here's how it works, and here's how you know if there's still juice left in the trade, meaning there's more money left to be made. The market is roughly 6 to 8 months forward looking. So the market is looking towards December right now. So the market is pricing in an interest rate of roughly 4.25%. Now the expiration date on these calls that we bought is for January of 2025, so roughly 1 month after that. So if we hold these plays until December, the market's going to be looking roughly forward until July. So July, we're expected to be somewhere in the range of 3% from 5.5%. So when the market looks forward and sees 3% as the interest rate, the question you're going to ask yourself is, how much lower can it go? And Jerome Powell at the Federal Reserve already said the neutral rate is somewhere around 2.5 to 3%. So when we're in December, looking 6 months forward, it appears that everything will be priced in roughly in December. So that's when I plan to hold this trade till. So you guys spoke and I listened. I'm making an entire course from A to Z, everything that I know about the stock market, everything I know about finance, and how you guys can reproduce my results of going from $0 to $2 million in 5 years. I'm going to teach you everything that you need to know, when to enter the trades, when to exit the trades, what stocks to do these trades on. You will have the full comprehensive guide, everything I do. I already have some of my friends reproducing these results. I had a friend that started about a year ago with what I do. He's already cash flowing like $5,000 to $10,000 a month on a small account. If you want to get on the wait list for that course, it's going to drop in October, so check that out below for pre-launch pricing. And if you made it this far, like and subscribe. I drop a video every other day about the stock market.